Savings, borrowings from friends or family, borrowings from friends or family, borrowings from friends or family. So I think you know about this form of business. There are fewer legal formalities involved on formation, fewer legal formalities. There are fewer legal formalities involved on formation. So fewer legal formalities involved on formation. Another thing you need to be able to know about this particular form of business is that it is easy to change can just say easy to change the business dealings or structure. It is easy to change the business dealings or structure. The other thing you need to be able to know about it is that there is personal customer touch. Another thing to know about it is that there is no principle of separate legal entity. There's no principle of separate legal entity. There's no principle of separate legal entity. So these are among the key characteristics of a sole proprietor form of business. So if you know these ones, then basically you can be able to compare with the other side of the company. So for example, in this case, when you talk about this business being owned by one person, so from this one, you can be able to compare on the side of a company. So in the side of a company, if it is a private company, it must have persons of 1 up to 50. So that is the ownership. If it is a public company, the ownership is actually at least 2 persons. So that is a difference you can actually be able to get from the ownership. The owner enjoys profits alone. So in a company, the profits are actually shared in form of dividends to the shareholders or basically the owners. So there, the profit is normally shared among the owners. So that is a distinction. Suffers losses alone. So in the company, basically the losses are actually basically borne by all the owners of the company. Then source of capital is from savings, borrowings from friends, and basically also from family. On the side of company, so you obviously know, we've learned about it. We can have share capital or debt capital. Share capital or debt capital. So that is a difference you can actually be able to get from that particular characteristic. Share capital or debt capital is the major form of capital for a company. So there are fewer legal formalities involved. On the side of the company, a lot of legal. So you have to go through a long process. So many legal formalities involved on the side of a company. Many legal formalities involved on the side of a company. So there are many legal formalities involved. It is easy to change the form of business dealings or structure. In the company, is not actually easy because the operations are actually very big. So if it is a manufacturing company, it has several departments. So it is not actually easy to change the form of business compared to a sole proprietor. So that is a distinction you can actually be able to mention. Then there is personal customer touch. So in the company, there's no personal customer touch. In this case, we simply mean that the business is actually basically run by directors, not the owners of the company. So, you know, like in a company is whereby now they simply employ directors to run the business. So the owners of the business employ directors to run the business. So there's no personal customer touch. For this particular person who owns a sole proprietor form of business, is actually able to interact with the customers on a day-to-day basis. But in a company, there's usually no personal customer touch. So shareholders are basically waiting at the end of the year to get the dividends. So they don't even interact with the customers. So there's no personal customer touch in the case of a company, but in the sole proprietor, it is there. There's no principle of separate legal entity. So what do you mean by this? In a company, we've understood that as per the principle, or basically the rule common and company limited is that the company is actually always separate from the owners. But in a sole proprietor, that particular principle does not actually exist. So the business is like the business and the owner are like one and the same person. For example, in this case, there's no limitation in terms of liability. So if the business has some liabilities, they must basically be borne by, or they'll be bared by the owner of the business. So there's no principle of separate legal entity in a sole proprietor, like in the case of a company, whereby we say a company is a person on its own and a sole proprietor is actually, basically in this case, there's no distinction between the owner and the business itself. So those are basically some of the differences you can actually be able to get from a sole proprietor comparing with a company. So the key thing here, as I told you, is just for you to be able to know the characteristics. In this case, if you know the characteristics, then basically you can be able to mention either the differences with the other form of business, or you can be able to raise the disadvantages. By simply looking at the characteristics, you'll get a disadvantage. So what is the most important thing? Not to basically cram each and every point advantages over the other, but just to know the characteristics. If you're able to list them, then just compare with the other side. If you compare with the other side, you'll get a distinction, or alternatively, you'll be able to get an advantage of that form of business with the other form of business. For example, in this case, you've mentioned the distinctions at the same time, probably maybe some of the advantages, for example, of a sole proprietor over the other form of business. So if you look at each and every characteristics, either you can be able to see an advantage, or you can actually be able to see a disadvantage if you compare with the other side of the business. So like here, fewer legal formalities, it is an advantage. Profits are actually enjoyed by the sole owner, it is actually an advantage. There is personal customer touch, so that is actually an advantage. It is easy to change the form of business dealings, an advantage. That is also it doesn't require huge capital to start or commence this form of business. So Lamek, I don't know why you are not on mute. Lamek, ensure you're actually on mute. So you're saying there are fewer legal formalities. That is an advantage. Source of capital, you don't need a lot of capital to start a sole proprietor form of business. For example, if you want to start some timber business, basically you can raise, for example, like start with maybe 5,000. So like that. But for a company, even forming a company, you'll spend more than 5,000 shillings. So basically in form of capital needed to set up a company is actually more compared to a sole proprietor. So capital is not basically required as much compared to the other forms of business. Another advantage that you can actually be able to mention, it is easy to keep in a sole proprietor because you are the sole owner. So this one you can be able to get that advantage from here. So you are the only one who knows the business secrets of your business. So they are not actually basically shared with any other person. You know, like in a company or a partnership, so that particular form of business is owned by several people. So they are likely to know more about what is actually happening in the business. But for a sole proprietor, it is actually very easy to keep what we call business secrets. It is easy to keep business secrets. Then another thing is that here in a sole proprietor, you said personal customer touch, which you've already mentioned, easy to change the form of business. Owner enjoys profits alone. Easy to keep business secrets. So there are certain requirements that must be met by a company which are not actually a must to basically be in this particular. For example, in this case, for a public company, so they are mandated to publish their books of accounts. So they are mandated to publish their books of accounts for the case of a public company. But for a sole proprietor, they don't need to publish their books of accounts, for example, maybe on their website or maybe anywhere. So in this case, they don't make their affairs so public. So this requirement in terms of maintenance of books of accounts and publishing them, it is not mandatory for a sole proprietor. Basically, it just be for the benefit of the owner of the business to ensure maybe he runs the business efficiently. But there's no any requirement, for example, under any law that this particular owner of a sole proprietor form of business, he must maintain his books of accounts and actually publish them and basically also ensure they're actually audited. So it's not actually mandatory or mentioned anywhere in any law for him to be able to do so. But for the case of companies, then they'll be required to maintain their books of accounts, and of course, for a public company to ensure it publishes its books of accounts. It publishes its books of accounts. So the same case, or the same way, they could ask for the advantages of maybe a company over a sole proprietor. So as I've told you, just simply compare the characteristics, and from them, you'll be able to see several disadvantages. For example, there's no principle of separate legal entity in a sole proprietor. That is a disadvantage, because in this case, we are saying the liabilities of the business are actually the liabilities of the owner of the sole proprietor. So that is actually an advantage that the company will have over a sole proprietor. In this case, you are saying that the source of capital. So there's a wide base for source of capital for a company. It can be able to sell shares. It can raise capital through debt capital. But in this case, for a sole proprietor form of business, it is actually quite limited. You can only be able to do maybe savings or maybe borrow from friends to be able to raise the capital. But for them, they can be able to sell shares. People come in as investors. They can be able to sell debentures, and they'll be able to raise capital. So suffering of losses alone, so it's not the same case in a company. So the losses are actually basically bared by all the owners of that particular company. So that is basically an advantage a company will have over a sole proprietor form of business. So that is basically how you can be able to distinguish between a sole proprietor and a company. So maybe there could be a question about a partnership and a company. So a partnership. So partnership characteristics. So they are regulated by the Partnership Act. So the business is actually owned by 2 up to 20 persons. So if it is a banking partnership in banking businesses or insurance, it is actually 2 up to 10 persons. So what else do you know about a partnership? So in a partnership, the profits are shared among the partners. So the profits and losses are shared among the partners. There is no principle of separate legal entity. There is no principle of separate legal entity. There's no principle of separate legal entity. Capital is contributed by the partners. Capital is contributed by the partners. It is contributed by the partners. Also, among partners, they'll be able to share the duties in that particular business. So duties are normally shared among the partners. So duties are shared among the partners. So these are some of the characteristics that we have for a partnership. And of each and every characteristic with a company, you'll be able to get some form of this. Here, companies are regulated by the Companies Act. Companies Act. So here we are saying that they're actually owned by 2. If you compare with the side of a company, you've said a private past maximum limits. at least 2 persons with no maximum limit. So that is a distinction you've already got. So the profits and losses partners. So here, what you can be able to get as a distinction, the tax liability is on the partners, is on partner company called corporation tax. So that is a distinction. You know profit of a partnership business as you've been taught in public finance and taxation. So basically, once individually, you tax them individually. You don't tax the partnership business itself. Once you've gotten the profits of a partnership business, after the calculation, you know it to the profit sharing ratio. So once you've individual, that's when you basically tax them on the normal graduated scale for individual taxation. But in public finance, you just simply apply on the here falls on the business in the company. But in the case of a partnership, it actually falls. That is basically a distinction. Then there's no of separate legal entity. So the principle of separate legal entity, that the partnership business and the partners are just viewed as being one and the same person. So there's no distinction between the partnership business itself and the owners. But in the case of a company, the principle of separate legal entity, the company itself and the owners are two different persons. The company, life of the owners. But in the case of a partnership, if there's no actually basically any agreement, then probably the partnership can actually come to an end unless there's actually an agreement whereby they can be able to continue to operate the business. Capital is actually contributed by the partners, so they contribute capital on the formation of that particular business. So here, in the case of a company, it is through share capital, sale of shares, and debt capital. There's this other one. Duties are actually shared among the partners. Probably they'll be able to run the business by themselves. So by simply the duties among themselves. For example, if it is a clinic that is the owner who has actually specialized in pediatrics, there's a gyna who deals with basically surgery. So you find pediatrics basically concentrated in that and set up a clinic. So they are likely to work in their areas of work. But in the company, as about it, they are directors. So companies are, so shareholders basically put them there to be able to run the business. So company are not by themselves. But in the case of a partnership, it can actually happen. They can be able to run the business by themselves. And of course, they'll be performing duties according to their area of specialty. Those are some of basically a company. So I want us to finalize with the last one. So that is a cooperative society. Cooperative society. So the same case, if they ask for the advantages, compare the characteristics with the other side, you'll either get a disadvantage or a disadvantage. So cooperative society. So they are regulated by the Cooperative Society Act. Regulated by Cooperative Society Act. Society Act. Raise capital through membership. Membership, government grants, or alternatively donor funding. Also, membership is drawn from a very specific area. Membership is drawn from a specific area, Membership is usually drawn from a very specific area. Then another thing, their form of capital is homogeneous or uniform. Form of capital is homogeneous, simply means it's actually uniform or uniform. It is uniform. Objective is to serve members. Primary objective is to serve members. So profit for them is actually secondary objective. Profit making is a secondary objective for them. Profit making is a secondary objective. They're usually run or managed by a committee drawn from them. So they are managed by a committee drawn from the members. By a committee drawn from the members. So these are some of the characteristics among others. So there are several of them you can be able to get in your note, but these are just the major ones. So they are usually regulated by the Cooperative Society Act. So these are simply form of association that are normally basically formed by people probably of the same profession, so that they can be able to benefit themselves as members by being able to combine their efforts, or basically by coming together. So maybe it could be like milk farmers, or basically dairy farmers, or basically also are basically producing milk. So dairy farmers in a particular area deciding to come together, combine their efforts. So they are people of the same profession, that is dairy farming. So with that, basically they'll be able to attract donor funding, government grants, and even raise enough capital in terms of membership fee, and they can actually even be able to set up a milk processing plant. So that is why they are actually majorly formed. So they are majorly formed to serve their members by simply combining their efforts. So they are usually regulated by the Cooperative Society Act, and majorly their membership is normally drawn from a very specific area. So these dairy farmers you'll find, basically they are maybe probably from just Muranga County. So that's basically where they do a lot of dairy farming. So they're actually able to come together in a cooperative, and with that, they'll be able to set up maybe a milk processing plant where they can be able to take their milk at each and every day, where it is processed, maybe packed, and basically sold to other areas. So once it is actually sold, then the members are actually able to maybe get their money from the sale of the milk. So other than that, they can be supported in other areas or activities. For example, in this case, getting dairy feeds, the feeds, or basically those kind of foods the cows can be able to take at a very subsidized price, because they can be able to get them in bulk. They put them at the cooperative, and members are actually able to get them from there. So that is basically what we mean by, so that is the best way, probably maybe I could explain what is a cooperative society. So membership is usually drawn from a very specific area, Muranga County. If it is Kericho County. Form of capital is usually very uniform. So if the membership fee is actually 1,000 shillings, all the members will actually be able to pay 1,000 shillings. Their primary objective is usually basically majorly to serve members first, before even they basically look at maybe making any form of profits. Then they're usually managed by a committee drawn from the members. So if there are 1,000 members, they'll be able to choose, let's say, for example, 20 members to be running the activities of that particular cooperative society. So these are among the key characteristics of a cooperative society. And as I've told you, You know the drill. Basically, if you just compare with the other side of a company, you'll get a distinction. So cooperative societies are regulated by the Cooperative Society Act. Companies Act. Raise capital through membership fee, government grants, donor funding. Companies, share capital, debt capital. Membership is actually drawn from a very specific area. Compare with a company, membership is drawn from a very wide area, even the whole country. A shareholder in Safaricom can be able to come from Malindi, Migori, Kisii, Muranga, Embu, everywhere across the country. So in the case of a company, the ownership or membership is basically drawn from a very wide area. It's not like a cooperative society. The form of capital is actually very homogeneous, very uniform. So the membership fee is actually 1,000. All of them will pay 1,000. In a company, it is heterogeneous. It is not uniform. In a company, you basically acquire ownership according to your financial strength. Basically, you can find one shareholder has shares worth 2 million, another one has shares worth 1 million. So it just depends on your financial strength. So in this case, for the case of a company, the form of capital is not uniform. It is not uniform as in the case of a cooperative society. Their primary objective is to serve members. Profit making is a secondary objective. Is that the case in a company? No. Basically, the major purpose as to why basically people buy shares in a company is to be able for the company to be able to make profits, and they're actually able to get dividends from the company. For the case of a company, the primary objective is profit making. But in the case of a cooperative society, it's serving of members. So that is a distinction. They are managed by a management committee drawn from the members. In the case of a company, they actually appoint experts or directors to run the company. So these ones, they are likely to suffer from what we call lack of expertise in terms of running of its activities, because maybe the members don't actually understand how to run a business. So they can suffer from not being actually able to maybe run the affairs of this particular business actually appropriately, compared to a company whereby they're actually able to employ experts in terms of directors to run the affairs of the company. Those are among some of the differences you can actually be able to find or get between a cooperative society and a company, a cooperative society and a company. The same case, they could ask for the disadvantages or advantages. You just simply compare the characteristics. From each and every characteristic, probably you'll get either a disadvantage or you'll realize it is actually an advantage over the other. It is actually an advantage over the other. So there's that one from November 2018. So I think I've covered quite enough on this particular topic. So so maybe we can move to the other topic there. So we have that particular question. It's question number 1A. It's November 2018. November 2018. It says, on 1st September 2018, Peter Kioko decided to form a company under the name PK Limited. Before the company was duly formed, Peter Kioko made a contract for the company in which PK Limited received a down payment of 500,000 shillings for the supply of household items to Fanica Limited. PK Limited has since been incorporated, but remains in breach of the said contract. Fanica Limited feels aggrieved and has approached you for legal advice. Analyze the legal principles applicable in the above case and advise Fanica Limited So that particular question is actually from formation of companies, specifically the rules governing what we call pre-incorporation contracts, pre-incorporation contracts. It's from this particular topic, formation of companies. So there they are saying that there's this guy known as Peter Kioko. In that case, Peter Kioko is a promoter of that company. So he actually entered into what we call a pre-incorporation contract with that particular other company for the supply of, household items. But basically, after the formation of the company, this particular company has not actually been paid, basically the remaining amount. So they are saying that has since been incorporated, but remains in breach of the said contract. So Fanica Limited feels aggrieved and has approached you for your legal advice. So in this particular topic, we learned about who is a promoter. Promotion of the company. We defined what is promotion of the company. We also learned about the duties of a promoter. We also learned about pre-incorporation contracts. We also learned about how the promoter, or basically we learned about the remuneration of a promoter. How the promoter can avoid liability on pre-incorporation contracts. How the promoter can avoid liability on pre-incorporation contracts. How the promoter can avoid liability on pre-incorporation contracts. Then we learned about the procedure of incorporating a company. Then we learned about the memorandum of association, and clearly we looked at the clauses in a memorandum of association. So we talked about the capital clause, name clause. Then we talked about capital clause, name clause, objective clause, capital clause, name clause, objective clause, association clause, and the liability clause. Then also we looked at the articles of association. So here we learned about the contents and more so the procedure to alter the articles of association, or basically the requirements or the procedure of altering the articles of association. So these are among the key things we learned about under formation of companies. So like, for example, in that case of that particular question, so they're asking about the rules governing pre-incorporation contracts. You should actually clearly advise this particular company known as Fanica Limited as to what are the requirements in terms of pre-incorporation contracts. So what we learned about the rules governing pre-incorporation contracts, so we said that all pre-incorporation contracts are actually void. They are void against the company. So the pre-incorporation contracts are actually void against the company, and the company cannot be held liable. So there are usually four rules. So all pre-incorporation contracts are actually void against the company, and the company will never be held liable. Then number two, if a company renegotiates a pre-incorporation contract, if a company renegotiates a pre-incorporation contract, so this actually simply validates, it validates the contract, and therefore it can be held liable. So if the company negotiates a pre-incorporation contract, the contract becomes valid, and the company can be held, liable, now in this case, can be held liable. And then number three, any person who purports to enter into a pre-incorporation contract on behalf of the company will be held personally liable. So any person purporting or basically entering into a contract on behalf of the company, any person purporting to enter into a contract on behalf of the company before it is formed, will be held personally liable, Then the last one, number four, a company cannot enforce a pre-incorporation contract. A company cannot enforce a pre-incorporation contract. So these are the four key rules governing pre-incorporation contracts. So those are the four key rules governing pre-incorporation contracts. So in that question, how you can just be able to answer it is simply to say, analyze the legal principles applicable in the above case and advise Fanica Limited. So what you simply say, the applicable legal principles in this case relate to rules governing pre-incorporation contracts. So that's how basically you start with your answer. You simply say, the applicable legal principles in this case relate to rules governing pre-incorporation contracts. So if you start with that particular point, the examiner basically will be able to know that this is actually a student who has understood what the question is testing about. So once you mentioned that point, that the applicable legal principles in this case relate to rules governing pre-incorporation contracts. Now, basically, now you go to the details. You now elaborate now further and say, for any pre-incorporation contract entered into by the promoter, so for example, you start with the first one, any pre-incorporation contract, so the rules just say the rules actually state, basically the rules governing a pre-incorporation contract actually state if a promoter, or basically any person, enters into a contract before the company is actually incorporated, he will be held personally liable. Then also in this case, all pre-incorporation contracts are actually void against the company, and the company cannot actually be held responsible. Then also you go further and say, if the company renegotiates the pre-incorporation contracts, then it can be held personally responsible. But in this case, it can be held now liable for that particular contract. And then also you further clearly finalize by saying a company cannot actually enforce a pre-incorporation contract. Therefore, with that, after you've stated the facts, now you relate them to the question. You say now, in this case, PK Limited cannot be held liable for the contract because the contract was entered into by the promoter of the company, Peter Kioko. So Fanica Limited can only be able to hold responsible the promoter, that is Peter Kioko, and not actually Fanica Limited as the company. So in this case, the party that will be held responsible for the breach of the contract is actually the promoter of the company and not actually the company itself, PK Limited. So you've said the applicable legal principles relate to rules governing pre-incorporation contracts. Then you simply say which states, you can even be able to mention them in a number of points, which states that all pre-incorporation contracts are void against the company. You can be able to say that, then also comma. Then if the company renegotiates a pre-incorporation contract, it will be held liable. And then you go further and say, if any person enters into a contract on behalf of the company before it is actually formed, he will be held personally liable. And also finally, a company cannot actually enforce a pre-incorporation contracts. So you've actually been able to state the facts. Now you relate to the question. You say, in this case, PK Limited cannot actually be held responsible. Peter Kioko, who is actually the promoter who entered into the contract before the company was formed, is the one who will be held responsible. So therefore, Fanica Limited can be able to sue Peter Kioko for the breach of the contract and not PK Limited as a company. Because as according to the rules governing pre-incorporation contracts, you can be able to see in all of them, there's nowhere the company can be held responsible, So that's how basically you can be able to answer that particular question. So it was actually from the rules governing pre-incorporation contracts. So probably they could bring a scenario, probably just simply tell you to state the rules governing pre-incorporation contracts. You simply state the rules governing pre-incorporation contracts. So that particular question was actually from formation of companies. So formation of companies exactly from pre-incorporation contracts. So in this topic, we learned about who is actually a promoter and what is actually promotion of the company. So we said promotion of the company or formation of a company, it is simply that process that is normally undertaken to set up a company as a going concern or to exist for the foreseeable future. That is promotion of the company, because they could ask you, define promotion of the company, or they could ask you, who is a promoter of a company, 2 marks, or define promotion of a company, 2 marks. So you say promotion of a company, it is a process that is normally undertaken to set up a company as a going concern or to exist for the foreseeable future. Then if they ask who is actually a promoter, is simply the person who now undertakes that process. A promoter of a company is a person who undertakes the process to form a company and set it up as a going concern or to exist for the foreseeable future. So during that process, what does the promoter do? The duties of a promoter. So they could ask the duties of a promoter. So in this case, what are the duties of a promoter? So the promoter, number one, what he'll do, he'll suggest or propose the name of the company, that this company of ours with Teresia, Susan, and Stephen. So we want it to be called Stephen, Susan, Teresia, and Job Company. So in this case, our promoter is actually Stephen. So that is basically what Stephen will be able to propose. So he basically proposes or suggests the name of the company. Then number two, what he does, he prepares the constitutive documents. So when I mention the constitutive documents, most obviously, you know, it is the memorandum and articles. So these are key documents required on the formation of the company. So he prepares the constitutive documents for the registration of the company or formation of the company. That is the memorandum and articles of association. Number 3, he actually proposes who will be the first auditors. So remember, in this case, there are no members to appoint the auditor. As I told you, under auditors, basically the members are the ones who appoint the auditor at the AGM. One of the key things that actually happens at the annual general meeting of a company is appointment and reappointment of auditors. But now in this case, how do you hold an AGM of a company that is not in existence? So therefore, in this case, what will happen, the promoter of the company will simply propose who will be the first auditors, first bankers, first company secretary of the company, and first directors of the company. So in the same case, you are saying directors are appointed by the members at the annual general meeting. But how do you appoint a director as a member, yet the company is not even in existence? You as a promoter of the company, you will propose that will basically serve as the first directors until when the first AGM is actually held. So you're saying duty number 3, propose who will be the first directors, first auditors, first company secretary, and first bankers of the company. So that is basically what he'll actually be able to propose in this case. Then the other thing that will actually happen with regard to the promoter, he'll basically enter into agreements so far as they're actually necessary for the formation of the company. For example, these pre-incorporation contracts, he will be able to enter into them to be able to facilitate the formation of the company. For example, in this case, if he's to acquire an office in advance, he'll be able to do so. Enter into any agreements or contracts so far as necessary to enable in the formation of the company. And then once he has all the requirements, then he'll actually be able to proceed and register the company with the registrar of companies, register the company with the registrar of companies. So in this case, it will happen by simply filling out the necessary documents and depositing them with the registrar of companies, attaching all the requirements in terms of documents, and therefore thereafter, of course, the company can be incorporated or registered. So anything that actually happens before that date of the issue of the certificate of incorporation is what we are calling pre-incorporation contracts. So those agreements are the ones you're calling pre-incorporation contracts. So the company will be seen to only have been incorporated or been formed once it gets a certificate of incorporation from the register of companies. So that date indicated on that certificate is when now the company will be seen to have been formed, or it can be able to commence business. But anything that actually happens before that date on the certificates is what we are calling pre-incorporation in terms of contracts. So there's one key thing that I actually mentioned about duties of a promoter is that this particular promoter you're talking about, he has a fiduciary duty to always act in good faith or in the best interest of the company. So in good faith or in the best interest of the company. So there's normally a question to this particular area that I want to talk about. So he has what we call to act with what we call good faith and in the best interest of the company. So he has a fiduciary duty to act in good faith and in the best interest of the company. So therefore, this is actually very important. In case actually the promoter sells any asset to the company before it is actually formed, he must actually be able to reveal the profits. So failure to do so, they'll be seen as being secret profits that are actually made by the promoter. And the failure of the revelation, the company has a right to recover the profits. So this is actually very important. You must never forget about it. We are saying the promoter of the company has a fiduciary duty to always act in good faith. And in any case, he actually sells an asset to the company, and therefore, in this case, he makes any profit on the asset. He has to reveal the profits to the company after formation. Failure to do so, they'll be taken to be secret profits, and therefore the company has a right to be able to recover the secret profits. So maybe they could ask, how can the company recover the secret profits? How can the company recover the secret profits? In this case, if the asset is actually still in existence, if the asset is actually still in existence, existence of the premises of the company or within the company, they can be able to recover what we call the purchase price. So they simply recover the purchase price and return the asset. If they can be able to return it to the promoter. So they can recover the purchase price. Number two, if the asset probably has already been sold by the company to any other third party, they can be able to recover the secret profits. But therefore, in this case, there's no asset to return. You've already sold it as a company, but you've discovered that this promoter made a secret profit. What do? You just recover the secret profits. But if you still have the assets, you can recover what you call the purchase price by simply returning the asset and asking for your money. You get your money. Because they could ask, how can the company recover any secret profits made by the promoter in terms of selling of an asset to the company? So they put there 2 marks or 3 marks. So that is basically how you can be able to approach such kind of question. So it is something they like testing. So they like testing that one. So it is important I mention it. About pre-incorporation contracts. So this particular area from here, just be guaranteed probably there will be a question. So there'll be a question from this particular area about remuneration, pre-incorporation contracts, duties of a promoter, like that, probably high chances. It's like you're 100% guaranteed there'll be a question from here. So remuneration of our promoter. Remuneration of our promoter is that we say that there's no any requirement under the law that the promoter of the company must be remunerated or be paid a salary for the work he has done as the promoter of the company. So there's no any requirement under the law that this promoter, for the work he has done as a promoter, he must be paid. But of course, the company itself can be able to decide as to how they can be able to remunerate a promoter. How can the company remunerate a promoter? Number one, how can they remunerate a promoter? Number one, they can allow the promoter to be among the first directors of the company. That is number one, how they can be able to remunerate. Number two, they can be able to give the promoter free shares for the work he has done as a promoter of the company. So they simply give him free shares. Or alternatively, they can give him shares at a very fair price. If it is a public company, that is number three. If it is a public company that is being formed, so you've said number one, allow him to be among the first directors. Number two, give him free shares in the company or shares at a fair price. Number three, we are saying number three. If it is a public company that is being formed by the promoter, what can actually happen in this case? For example, if he facilitates the sale of the shares of the company, he can be given commission on the sale of the shares. In this case, let's say, for example, he comes up with the prospectus. Remember, we said the company, before it gives out shares or issues shares, it normally basically advertises for the shares through a prospectus. So in this case, there's no board of directors in existence to come up with the prospectus. It is the promoter who came up with the prospectus and went through along the whole process of ensuring the shares of the company have actually been acquired. So you can be given commission on the sale of the shares of the company, the company. Number four, what can actually happen in this case? They can allow this promoter to sell assets to the company. But the key point here is to act in good faith, reveal any profits made on the sale of the assets, failure to which they'll be taken to be secret profits. So number four, you are saying allow the promoter to sell assets to the company. But you are saying, as I've told you earlier, it is important the promoter reveals any profits made on the sale of the asset, failure to which they can be taken to be secret profits. And you've said the company has a right to recover the profits. Then number five, after the company has been formed, they can probably enter into a formal contract with the company now to be paid or be remunerated a particular amount of money for the work he has done as the promoter of the company. Now the company has already been formed. So he comes to the company and basically negotiates with them. I've done the whole of this work for you as a company. So I want you basically to pay me a particular amount of money. So once they have entered into a formal contract, now in this case, the company can be able to pay the promoter, So that's how the promoter of the company can actually be remunerated. So if they ask, how can the promoter of the company be remunerated? So we've mentioned it. So they can put there 5 marks. So you must never forget about how the promoter can be remunerated. So there's another key point whereby we've talked about that for the pre-incorporation contracts, you can be able to see that this blame or this particular liability will actually fall on the promoter of the company, because you are saying the promoter of the company the company itself never will it be held liable for the pre-incorporation contracts. So probably the promoter is the one who can be held responsible. So there's this particular point here. How can the promoter of the company avoid liability on pre-incorporation contracts? How can the promoter of the company avoid liability on pre-incorporation contracts? So number one, what he can be able to do, what he can be able to do as a promoter is incorporate the company first before entering into any contract. And therefore, in this case, the question of pre-incorporation contracts won't arise. Just be patient as a promoter. Ngoja tu kampuni ikuwe formed, ndo uanze kuingia kwa contracts. In that case, the question of pre-incorporation contracts won't arise. That is number one way of how a promoter can avoid liability on pre-incorporation contracts. Number two, what can he be able to do? He can be able to buy an off-shelf company. So he doesn't have to go through the whole process of forming a company. So he simply basically buys or acquires an already formed company and probably just changes the ownership of that company in terms of shareholding, and therefore now start contracting with the company. So he won't actually basically wait for a very long period of time before basically the approval of his formation of his company. So he goes out there, there's already a company that was actually formed by another party. He buys it, and simply after buying it, he now basically starts to contract with the company. So number two, buying of an off-shelf company, and of course, proceeding to be able to contract with that particular company. Number three, he can enter into contracts with the assurance that he will be the majority shareholder stroke director, and therefore approval of these pre-incorporation contracts will be very easy because he's the majority shareholder. Even if after the company has been formed, company yezi ruka, kwa sababu yeye ndio the majority shareholder, he holds 90%. Company yezi ruka because at a vote for it, he'll simply just approve it after the company has been formed. Number three, enter into contracts with the assurance, or basically by simply knowing he will be the majority shareholder and of course stroke director of the company. Number four way, how he can be able to avoid liability, enter into a contract with third parties, of course, by simply informing them that in case the company doesn't actually basically approve these contracts, he will not be held personally liable. So he basically just informs a third party quite early enough. I'm the promoter of the company. In case the company doesn't basically approve this particular contract formation, don't hold me responsible. We are entering into a contract with you as a third party. The company has not been formed. But in case the company basically after formation doesn't actually approve this contract, don't hold me responsible. So that can be included as one of the terms under the contract, that in case the company doesn't actually approve the contract, don't hold me responsible. Don't hold me responsible. Then the last one, probably the last one, number five, what you can be able to do is enter into what we call provisional contracts subject to approval by the company after formation. It's just like, for example, in a school or a university, you're normally given provisional results. So those are not basically the final results. So you just basically inform a third party, these are provisional contracts, is subject to approval by the company after formation. So it's not like the real contract. So that's basically how this particular promoter of the company can be able to avoid the liability on pre-incorporation contract. Because generally, as we can be able to see from the rules governing pre-incorporation contracts, the blame is actually falling on the promoter, not the company itself. So how can he be able to avoid that liability? So he can be able to do so as we've just mentioned through those particular ways we've just mentioned. So it is important basically gather something about from here up to here. So you're like 100% guaranteed there'll be a question coming from this area. So I want us to look at a question. So there's that May 2018 question number 1A. It says, with reference to formation of companies, explain the meaning of the term articles of association. Number 2, describe effects of registration of the articles of association of a company. Then number 3, outline the provisions of the Companies Act which govern the alteration of the articles of a company. So you can start with the first one. So it's from articles of association. It is from articles of association. So define the term articles of association. It is simply a document containing the rules governing the internal affairs of the company. It is a document containing the rules governing the internal affairs of the company. So it is like the constitution of the company. It is simply a document containing the rules governing the internal affairs of the company, or how the affairs of the company will be run internally. So describe 4 effects of registration of the articles of association. So 4 effects of the registration of the articles of association. So what are the effects? So what they mean by this, once you deposit them with the register of companies, because we are saying it is one of the requirements when you are registering the company that you basically provide your articles of association. That's what they mean by registration. So you deposit them. Once you deposit them, you have registered them with the registrar of companies. So what are the legal effects? What are the effects of registering the articles of association? So number 1 effect. So they binds the members to the company. Number 2, binds the company to the members. Number 3, binds members among themselves. Then number 4, binds members in their capacity as members. Binds members in their capacity as members of the company. So so we are saying that once you register the articles of association, so these articles will be able to bind you as a member of a company to the company. What they mean by this, for example, if you are a member of the company, because you are saying it is a document containing the rules governing the internal affairs of the company. So if you do anything contrary to that particular document as a member of the company, then you can be held responsible by the company. So the company can take any action if you don't follow the rules governing the internal affairs of the company. So just the same case, if you don't follow the law, someone else can be able to take you to the court. So you as a member of the company, if you don't follow the law of the company can be able to take action. So that is what that particular point actually means. So it binds you as a member to the company. So if you do anything that is wrong or contrary to the articles, you can be held responsible by the company. So this one is the other way around. So in this case, if the company does anything that is contrary to the requirements of the articles, you as a member of the company, you can take up action. You can take up the action by maybe simply going to the court. So in this case, if the company has acted ultra vires, so you can be able to take action as a member of the company. It binds members among themselves. So you as a member of the company, you are held actually responsible to the other member of the company as per the rules governing the internal affairs of the company. So if you do anything contrary, the other member of the company can be able to take action. For example, it could be the majority members and the minority members. So if there's anything that is actually basically between them or against each one of them, either the majority members can be able to take action, or probably the minority members can actually be able to take action against the other members if any of them has done anything contrary or basically ultra vires, which is not actually basically as per the requirements of the articles of association. And then it binds you as a member of the company in your capacity as a member and not in any other capacity. Because you are saying there are simply rules governing the internal affairs of the company. So it will be able to bind you or hold you responsible as a member of the company and not in any other capacity. Maybe you could be a member of the company and also you are a creditor to the company. You are a creditor to the company. Also, maybe you are a debtor to the company. So it cannot hold you responsible like a third party. In this case, you are like in the status of a third party outside the company. So it will only be able to hold you responsible, you as a member of the company, as a member, in your capacity as a member. You could be a member of the company, as I've explained, and also you are a creditor. You normally supply goods to the company. So it cannot basically hold you responsible because you are a third party as a creditor. It will only hold you responsible as a member of the company. So it binds members in their capacity as members of the company. So these are basically the effects of registration of the articles of the company, the legal effects of the registration of the articles of association. So the last question there, it is they're asking us, or basically they are testing on the same case, outline the provisions of the Companies Act which govern the alteration of articles of association of the company, the alteration of articles of association of the company. So maybe this one I can just dictate to you, you write it somewhere. So the provisions of the Companies Act which govern the alteration of articles of association. So you can be able to write it somewhere down. Just simply say, as per the Companies Act, 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 the AOA can be altered. The AOA can be altered. The AOA can be altered. The articles of association can be altered through a special resolution. The articles of association can be altered through a special resolution. The articles of association can be altered through a special resolution. Full stop. Then you just say the alteration must be, the alteration must be as per the provisions, the alteration must be as per the provisions of the Companies Act. The alteration must be as per the provisions of the Companies Act, as per the provisions of the Companies Act, contrary to which, it won't be, contrary to which it won't be valid. It won't be valid. Contrary to which it won't be valid. Contrary to which it won't be valid. Contrary to which it won't be valid. Then just say, for example, the alteration should not violate, the alteration should not violate membership rights. The alteration should not violate the membership rights. The alteration should not violate the membership rights. The alteration should not violate the membership rights, comma. It must also be made, in good faith. It must also be made in good faith. It must also be made in good faith. It must also be made in good faith and in the best interest. It must also be made in good faith and in the best interest of the company as a whole. And in the best interest of the company as a whole. and in the best interest of the company as a whole. And in the best interest of the company as a whole. And in the best interest of the company as a whole. Full stop. They just say the altered articles. The altered articles must be filed with the registrar of companies. The altered articles must be filed with the registrar of companies. The altered articles must be filed with the registrar of companies. The altered articles must be filed with the registrar of companies. The altered articles must be filed with the registrar of companies, or must be deposited with the registrar of companies. The altered articles must be deposited with the registrar of companies, with the registrar of companies, with the registrar of companies. With the registrar of companies, with the registrar of companies. With the registrar of companies. So I think, so that's all about that particular question. So that's all about that particular question. So I think, let me move to something else. So I'll be able to wind up with this particular bit of MOA and articles in deeper details in our next class, but I want us to move to another thing. I want to move to something else. I'll wind up with the articles and memorandum in the next class. Let me move to something else. So just in the same sitting, so May 2018, question number 6B. Question number 6B. It says, in the context of meetings, outline 6 contents to be recorded in the minutes of directors' meetings. In the context of company meetings, outline 6 contents to be recorded in the minutes of directors' meeting. Then Roman 2, every company must hold an annual general meeting in each year. Explain 3 purposes of an AGM. 3 purposes of an AGM. So they're asking for the contents to be recorded in the minutes of directors, and then the purposes of an AGM. So that question is from meetings. So company meetings. So they're asking for the contents of the minutes, of a director's meeting. So as I told you, minutes are just minutes. So minutes of CHAMA, if you compare to minutes of which other meeting, they are usually the same. So you just know the contents. You've been taught in English how to draft the minutes of a meeting. So there's usually no difference, major difference between minutes of each and every kind of meeting. It's just the same. So for example, in that case, you'll be able to mention those minutes will basically state the date and time of the meeting, date and time of the meeting, date and time of the meeting, place where the meeting was held, place where the meeting was held, where the meeting was held. It will clearly indicate the directors in attendance, directors in attendance. It will clearly indicate directors absent, directors absent. Stock absent with apologies, absent with apologies. They'll clearly indicate the chairman of the meeting, the chairman of the meeting, the chairman of the meeting. Clearly indicate the secretary of the meeting, secretary of the meeting. Clearly indicate the agendas, agendas. Clearly indicate any other business. Then lastly, clearly indicate it will be signed by the secretary. They will be signed by the secretary and chairman. So those are the contents. So date and time of the meeting, place where the meeting was held, directors in attendance, directors absent or absent with apologies, chairman who was chairing the meeting, then secretary who was the secretary of the meeting. Agendas, what are the active agendas discussed? So now you'll have agenda 1, agenda 2, agenda 3, agenda 4, like that. Any other business? Then of course at the end down there, they'll be signed by the secretary and the chairman of the meeting. Then the other question is actually asking about what are the agendas that will basically be discussed at an AGM. So there'll be the appointment. So number 1, appointment. Appointment of directors. There'll be the appointment and reappointment of auditors. There'll be the approval of the annual accounts. So any other agenda, as stated in the notice convening the meeting, as stated. Then also the last one, approval of the annual dividends. Approval of dividends proposed. So these are some of the major agendas that will be discussed at an annual general meeting. So appointment and reappointment of directors, appointment and reappointment of auditors. So they'll be able to appoint either a new auditor or maybe remove the previous auditor. So just depending on what they want to do as members of the company. Approve of the annual accounts. So they'll be able to do that. Any other agenda as stated. So like currently, most companies are actually holding their AGMs because the previous year's financial statements have already been prepared. So you can see most companies are declaring profits. So like the banks, I think in the banking sector, almost all the banks have actually released their results. So they are saying they basically improved on their profits by 70%. So after that, basically now they'll prepare for the AGM probably before June, so that they can be able to now pay dividends to the shareholders. So there'll be the approval of the annual dividends to be paid to the members of the company. Then they'll actually also be able to discuss any other matter or agenda that has been stated in the notice convening that AGM. So apart from these agendas, there could be any other special agenda or special notice that has been given for any other agenda will actually also be discussed at the AGM. But these are the major ones that will never miss, at the AGM, So under company meetings, we discussed about the rule in Sharp versus Dawes, the rule in Sharp versus Dawes and exceptions. The rule in Sharp versus Dawes and exceptions. The importance of company meetings. We also discussed about the essentials of a valid meeting. Essentials of a valid meeting. Then also we discussed about the types of meetings. For example, in this case, like an AGM, general meeting, class meeting, can have a creditors meeting. Then we discussed about resolutions at a company meeting. So there were two major ones, which are like almost the whole semester I've been singing about them: special resolution and an ordinary resolution. So these are among the key things that we looked at under company meetings. So the rule in Sharp versus Dawes and its exceptions. So you say that the rule in Sharp versus Dawes, simply states that the rule in Sharp versus Dawes, I can see my camera is off. So the rule in Sharp versus Dawes states that a properly convened meeting in a company can only be held by 2 or more persons. That is what the rule states. A properly convened meeting in a company can only be held by 2 or more persons. A properly convened meeting in a company can only be held by 2 or more persons. So that is what the rule actually states. So the rule in Sharpe versus Dow states that a properly convened meeting in a company can only be held by 2 or more persons. So kwa kampuni meeting itakuwa tu halali kama imekuwa held na 2 or more persons. So that is what the rule actually states. But if you can recall very well, we said it doesn't actually prevail always. Under certain circumstances, special reasons, you might find that resolutions of the company have actually been approved by a single person, by a sole person. Since therefore, in such a case, you can be able to conclude this sole person was actually able to form a meeting and he actually basically came up with a company resolution. Because at company meetings, what normally happens, they are usually resolutions. So they make decisions, for example, approval of annual dividends. So they pass a resolution and people vote. But you might find that under special circumstances, that this meeting you're talking about that must be held by 2 persons, it is not possible for the meeting to be held by 2 or more persons. So what happens in such a case? The resolutions will likely only be approved by a sole person. So what are the exceptions? What are the exceptions? It is important you note these ones. What are the exceptions of this particular rule, whereby now 1 person can be able to form a meeting and come up with a resolution? So what are the exceptions? Number 1, a meeting convened by the order of the court. So if the court gives out an order and only 1 person attends, it can be taken as the proper quorum to come up with a company resolution. So number 1, a meeting convened by the order of the court, and it is actually basically only attended by one person. Number 2, a meeting convened now also by an order, but now in this case, by the order of the registrar of companies. If it is attended by 1 person, it can be able to form quorum. So number 1, we've said a meeting convened by the order of the court and is actually attended by 1 person. The person can be able to form a quorum for a meeting. Number 2, it is still an order, but now in this case, the order is from the registrar of companies. If 1 person attends, he can be able to form a quorum. Number 3, in a company whereby we have only 1 creditor and a creditor's meeting is actually to be held, that sole creditor will be taken to basically be a person who can be able to form quorum and come up with a resolution concerning him or her as the creditor of the company. So number 3, we are saying in a company where a creditor's meeting is to be held and we only have 1 creditor, and then number 4, a class meeting where the shares of the class are actually held by a sole person. So what we mean by a class meeting is basically a meeting of members of a class of shares. Like let's say, for example, ordinary shareholders. So if they are to hold a meeting and these ordinary shares are actually only held by 1 person. So this particular 1 person will actually be able to form a quorum for that particular meeting, Then number 5, at an adjourned meeting or postponed meeting, whereby the attendance is actually only 1 person. So there's a meeting today, it has been postponed to next week, but still actually only 1 person is actually able to attend. So this is a case, this particular 1 person will actually be able to form a quorum for the meeting. Then the last one, a board of directors meeting, for example, in a private company. So a board of directors meeting in a private company where the company has a sole director. So it has only 1 director. In such a case, if they are to come up with a directors meeting, so that sole director will likely be able to form a quorum and come up with the company resolutions concerning the board of directors. So a board of directors meeting in a private company where we have only 1 director or a sole director, he can be able to form a quorum, for a meeting, So those are the exceptions of this particular rule we are calling the rule in Sharpe versus Dawes, So if that one comes, then it will be very easy. So utaipepeta, ikikuja state, the first one will be Roman 1, state the rule in Sharpe versus Dawes. Then Roman 2, state the exceptions to the above rule. Then 4 marks or 6 marks. So that one utakuwa umeipepeta. 8 marks utakuwa umeweka kwa mfuko. Then importance of company meetings. So what are the importance of company meetings? So basically the meetings are just normally held in a company to deliberate on matters concerning the company, or basically issues facing the company. So you can be able to resolve them in a company meeting. And then number 2 can be able to talk about to discuss matters which can only be discussed or approved at either a general meeting or an AGM of the company. Then also to discuss matters concerning probably a class of shares, for example, by simply holding a class meeting, a class meeting. So what are the essentials of a valid meeting? So we talked about essentials of a valid meeting. So number 1, it must be convened by the proper authority. Number 2, it must be convened through a notice. So there must be a notice. Number 3, there must be minutes at the meeting. Number 4, there must be a proper person as the chair. Number 5, there must be a quorum. So these are the key essentials. of a valid meeting. So properly convened meeting in a company must actually basically be convened by the proper authority. Number 2, by a notice. Number 3, by at this particular meeting, there must be minutes. Then there must be a proper person as the chair. Then there must be a quorum. So, for example, here we've tackled a question concerning minutes. So they could ask, what are the contents of the minutes? They could ask, under notice, they could ask, what are the contents of a notice of a meeting? Or what are the requirements of a notice of a meeting? Under proper person as the chair, they could ask something about duties and powers of the chairman. So if they ask about the contents of a notice of a meeting, so a notice of a meeting of members of the company, so those are basically like free marks. So in any notice of a meeting, they'll indicate the date and time of the meeting in that notice. So the place or the venue for the meeting will actually be indicated. It will actually also be able to indicate the person convening the meeting. So the person convening the meeting. In that notice also, they'll be able to indicate the agendas. What are you going to discuss at the meeting? The agendas as to what you're going to discuss at the meeting. And then also it will have the company seal. It must be stamped so that you can know it is actually an authentic notice from the company. Then it will be signed by the person convening the meeting. For example, if it is the chairman of the board, he must be able to sign that notice. Then most importantly, it will have the seal of the company or the company stamp. It must be stamped or sealed. So those will basically be the contents of a notice of a company meeting. So that is what you can be able to answer if they ask for such. About minutes, I think we've discussed something about minutes. The proper authority to convene a meeting in a company, it is usually the board of directors. But of course, if the directors fail to convene a meeting, the members can take the matter in their own hands. For example, in this case, if the directors fail to convene an AGM, so that goes against the requirements of the Companies Act. What can happen in this case? At least a 10th of the holders of the authorized share capital of the company can be able to petition the court or ask the court to give out an order for a meeting to be convened in the company. So like those are the circumstances under which now the court can be able to convene a meeting. So they can be able to apply to the courts or petition the court that since the directors have not convened the AGM and yet it has already reached time, they can be able to maybe to ask the court or petition the court to convene a meeting. But the proper authority to be able to convene a meeting is usually the directors of the company or the board of directors, failure to which members can take the responsibility in their own hands. So that is what will happen in such a case. So I think for the other areas of meetings, I'll be able to wind up with them. in our next class. I'll be able to wind up with them in our next class. Then I'll also wind up on something about information of companies on memorandum and articles. Then I'll wind up with this one. Then I think we can now maybe cover shares, share capital, and debt capital. After that, shares, share capital, and debt capital after that. So I think with that, we've come to the end of today's class. So unless you have a question. So most importantly, take note of